Okay. So now let's look at this. Yes.
So for 12,400, will we put the July 1st?
Yeah. It's July 1st.
Okay.
Okay, so now we're going to look at unearned revenues and how we do the adjusting entries for the unearned revenues. So unearned revenues means that people have given us money before we've actually provided a service to them. So we're liable to give them that money back if we don't provide the service. Okay. So this is cash before the revenue is recorded. The kinds of things that we might see are rent, airline tickets, magazine subscriptions, customer deposits. Those are all things that could be unearned revenue. All right, so the adjusting entry for these, you're going to debit a liability account called unearned revenue. You're going to credit the revenue account. And we only have service revenue right now. Okay. So the adjusting entry for recognizing when you earn the revenue is to debit the liability account unearned revenue and credit the revenue account, service revenue. The next slide here will show you the T counts that you're decreasing a liability, which is debiting, and you're increasing a revenue, which is crediting. Okay?
If you look to the last one,
Go back to the last slide.
mm-hmm.
What was that? Let's see. So we're debiting the liability account, we're crediting the revenue account. So we have an example here. Sierra Corporation received $1,200 on October 2nd from R. Knox for guide services for multi-day trips expected to be completed by December 31. Unearned service revenue shows a balance of $1,200 in the October 31 trial balance. From an evaluation of the service performed for Knox during October, the company determines that it has earned $400 in October. So it's earned $400. So it's going to move $400 from unearned revenue to service revenue. So it's going to debit unearned service revenue, $400. It's going to credit service revenue, $400. Okay. So you're recognizing the amount that you've actually earned. All right. This one is a good slide again. It's in the book because it tells you the examples for unearned revenues. Could be rent, magazine subscriptions, customer deposits for future services. And then it shows you that you're adjusting entries to credit a liability, debit a liability and credit a revenue. Okay, so we're going to do one problem with this. BE47. So we're going to do that one problem, BE47. All right. So BE47 tells us, I left this here for a reason, because in this problem here, we're the buyer, right? We're a lien company, right? We're buying the insurance. We're going to use the same problem, but we're going to use it from the perspective of the seller of the insurance, Marshall. Okay? So it says, using the data in BE46, journalize and post the entry on July 1 and the adjusted entry on December 31 for Marsh Insurance Company. Marsh uses the accounts unearned service revenue and service revenue. Okay? So we were paid, how much were we paid? $12,400. So if we're paid, what's that tell us? What account is that?
Cash.
Cash. Cash is an asset to make it go up. We debit it, right? So July 1, we're going to debit cash, $12,400. But we're not crediting service revenue. Why?
Because they're earning it.
We haven't earned it yet. This $12,400 was for how much time?
2 years.
2 years, 24 months, right? So we're going to credit unearned service revenue. $12,400. And then every month we're going to do an entry to recognize how much we've earned. But in this problem, we're waiting till the end of the year to do it. So, the end of the year, we have to do an entry to recognize how much revenue we've actually earned. We've already done the math because this is the same problem. But had we not done the math, we would take the $12,400. We would, in the denominator, we would put the number of months that this is for, 24, because it's 2 years. The numerator would be the number of months that we've actually used up, or in this case, on the other side, how much we've earned. We've earned 6 months worth, 0.25, I guess it's the 3,100. So we've actually earned this. So on December 31, we're going to debit unearned service revenue, $3,100. And we're going to credit service revenue because now we've actually earned the $3,100. Okay. And then on our T accounts, we're going to call it unearned service revenue, and then this would be service revenue. So service revenue started at 0. Unearned service revenue had a credit balance of $12,400 on July 1. Then we do this entry here, and we debit unearned service revenue, $3,100. So we have $9,300 left to earn. And over here, we credit service revenue, $3,100, and that's how much we earned. So this is kind of a good problem because you can look from the side of, this is the buyer with the prepaid expense, right? And this is the seller with the unearned revenue. Same problem, but from the different sides, okay?
So,
Any
we
questions?
wouldn't put the cash take on there.
No, because if you don't, remember adjusting entries, we never use cash for adjusting entries. Never ever use cash for adjusting entries. All right, questions about that? Is everyone good with that, or?